In this video, I'm going to share how I turned $71,000 into $1.1 million in 2025, using a strategy that only won 27% of the time. Sounds insane, right? Because most people believe success in the market comes from being right, from having a high win rate or predicting where prices will go next. But what if I told you that you don't need to win often to make serious money? You just need to lose small and let your winners run long enough. From January to October 2025, I made 121 trades. Only 32 were profitable, giving me a win rate of just 27%. My average risk-to-reward ratio was 1 to 11, and I never risked more than 1% of my account on a single trade. That means if I lost small. But when I won big. And in this video, I'm going to break down my 4 most successful trades, one by one, how I found them, how I managed the risk, and how I held them long enough to capture the full move. Because the truth is, trading isn't about being right all the time. It's about staying disciplined long enough for the math to work in your favor. But before we dive into the 4 setups, let me explain the simple philosophy behind my strategy.
I'm a swing trader and a trend follower, but I only trade the long side. Why? Because when you short a stock, your upside is limited. If you're not using leverage, the most you can make is 100%. But when you go long, your upside is unlimited as long as the trend continues. That's why I dedicate all my energy to identifying and riding medium to long-term uptrends. The kind of trends that can multiply your capital several times over if you have the patience to stay in. My compass is simple, the 50-day exponential moving average, or EMA 50. If a stock trades above its EMA 50, it tells me one thing, the trend is up. I don't bother with EMA 10 or 20 because they react to every minor pullback. I'm not chasing noise, I'm following strength. The type of strength that big institutions create when they quietly accumulate shares over weeks or months. Once a stock breaks above its EMA 50 and begins to build momentum, I wait for short pauses or tight consolidations, what I like to call train stops. Imagine a high-speed train. It doesn't stop because it's broken, it stops to pick up more passengers before taking off again. That's exactly how strong stocks behave before the next leg higher. And in 2025, 4 of those train stops turned into life-changing trades for me. The exact setups that helped transform my account from $71,000 to over $1.1 million. Let me walk you through each one.
Trade number 1, Western Digital, WDC. From April to June 2025, Western Digital rallied nearly 90%, breaking decisively above its EMA 50, my first green light that the trend was shifting from recovery to expansion. When a stock can double in just a few months and still hold its gains, that tells me one thing: institutional money is stepping in and defending the move. After that sharp rally, WDC hit resistance around $56 to $57 and began to consolidate for about 4 trading sessions. Most traders would see that pause as exhaustion, a sign the move was over. But to me, that's where opportunity begins. See, when a stock pauses after a strong uptrend, it's usually profitable investors taking partial profits, not panic sellers exiting in fear. The difference lies in the volume. If the pullback happens on light volume, it means supply is drying up. There's no rush for the exits, only a brief rest before the next leg higher. I entered the trade right as WDC broke above resistance with a volume spike, confirming renewed demand. My stop loss was tight, just 1% of my total account, exactly as planned. Once the trade moved in my favor, I trailed my stop along the EMA 50, not EMA 20, because shorter averages would have shaken me out too early. I wanted to stay in for the entire wave, not just a small ripple. As of now, WDC is up over 120%, and I'm still holding since price hasn't closed below the EMA 50. This single trade contributed a significant portion to my 2025 gains,
And that's the power of patience. The pause isn't the end of the move. It's just the train stopping to pick up new passengers before the next acceleration.
Trade number 2. Vingroup, VIC. This next setup came from the Vietnamese stock market. Vingroup, the parent company of electric vehicle maker VinFast. In March 2025, VIC broke cleanly above its EMA 50, signaling a fresh shift in momentum. The volume expanded, the candles stretched, and for the first time in months, the price action showed real conviction. By early June, the stock had climbed more than 135%. After that, it faced some profit-taking and a pullback, then started forming what looked like a cup with handle pattern, or, depending on how you see it, a Volatility Contraction Pattern, VCP. Both formations point to the same thing: institutional accumulation under the surface and volatility drying up before a breakout. I entered around $3.08, right after price broke out of the handle on increasing volume. My risk was fixed, 1% of my account, no exceptions. Once in, I followed my system. As long as VIC held above its EMA 50, I'd stay in the trade. It wasn't a straight line. The stock had its pullbacks, its quiet days, and a few fakeouts. But the structure remained intact, and momentum kept building. By mid-year, the trade had delivered over 120%. And I'm still holding, since price hasn't closed below the EMA 50. What this trade reminded me of is timeless. Markets may differ, but human behavior doesn't. Fear, hesitation, and accumulation create the same patterns everywhere, from Silicon Valley to Saigon.
Trade number 3. GX, or GEX. In mid-April 2025, GX crossed above its EMA 50, signaling the start of a new uptrend. The move wasn't explosive, just a steady 34% climb, but what came after caught my attention. The stock started moving sideways, forming a tight consolidation zone. To me, that's the sweet spot. I marked a price box between $1.06 and $1.10, waiting for confirmation that buyers were still in control. When GEX finally broke above $1.10, I entered, risking exactly 1% of my account. Over the next several weeks, the stock rallied more than 120%, riding a clean, structured uptrend. Every dip held above the EMA 50, giving me confidence to stay in. Then, when price finally closed below the EMA 50, I exited with an 80% gain. It wasn't the top, but that's not the goal. My job isn't to sell perfectly, it's to capture the bulk of the trend. If I had used a tighter stop, like the EMA 20, I would have been shaken out too early. Patience and structure, not prediction, made this trade work.
Trade number 4. Micron Technology, MU. In early May 2025, Micron Technology, MU, broke decisively above its EMA 50, my first green light for any potential trade. That single move told me one thing: momentum was shifting. But instead of chasing, I waited. Over the next few weeks, MU began forming a volatility contraction pattern, a sequence of tightening pullbacks that signaled growing pressure under the surface. Each contraction got smaller, 19% to 9% to 6%, and volume kept fading, a textbook sign that sellers were running out of ammunition. I drew a clean trend line across the highs of each contraction, marking my breakout level. Then came the trigger. MU exploded through resistance on strong volume. That was my cue. I entered with my standard 1% risk, letting structure and trend do the rest. Within a month, MU surged more than 60% with barely a pullback. The price stayed firmly above the EMA 50, and that's all I needed to see to keep holding. It's a perfect reminder that great trades don't come from prediction. They come from patience, structure, and waiting for the market to show its hand.
My core principles. My strategy is simple, but it demands absolute discipline. Over the years, I've learned that consistency beats complexity every single time. These are the principles I live by. 1. Trade with the trend. I only buy stocks trading above the EMA 50. If it's below, I don't touch it. Fighting the trend is how traders lose money. 2. Wait for the pause. Every big move needs to rest before its next leg up. Those brief consolidations, the stations where strong hands hold and weak hands exit, are where the real opportunities form. 3. Risk small, let profits run. I risk exactly 1% per trade, no exceptions. My edge isn't in predicting direction, it's in managing risk. Small losses keep me in the game long enough to catch the outliers. 4. Master a few setups. Horizontal bases, VCPs, and cup with handles. That's it. Simplicity builds focus, and focus builds mastery. Like Bruce Lee said, I fear not the man who has practiced 10,000 kicks once, but the man who has practiced one kick 10,000 times. Trading is the same. Mastery isn't about knowing everything. It's about doing one thing extraordinarily well. Don't try to learn everything. Master a few setups so deeply that taking them becomes second nature.
That's how I turned $71,000 into $1.1 million in 10 months, with just 4 trades doing most of the heavy lifting. No magic indicators, no predictions, just trend, timing, and discipline. If you found this video valuable, hit the like button, subscribe, and consider supporting the channel through Super Thanks or becoming a member. It helps me keep creating deep dive content like this. Remember, in trading, it's not about how often you win. It's about how long you can stay in your winners.